We all know Wall Street is meant to make profits, but there's something very sinister that Wall Street isn't sharing with the general public. There have been several instances throughout history where Wall Street has been accused of treating clients poorly or engaging in unethical behavior. I'd go as far as saying that Wall Street treats retail investors like cattle they have to fatten up and sell for a profit. Did you know that Wall Street might be deliberately hiding the benefits of index funds from you? It turns out that these funds are often less profitable for financial firms that actively manage funds because they charge lower fees and commissions. This means that Wall Street has a financial incentive to steer you away from index funds and towards more expensive actively managed funds. Shockingly, this means that many investors are missing out on the potential benefits of index funds, including lower costs and diversified exposure to the stock market. Actively managed funds often have marketing campaigns and high-profile fund managers promoting them, which can draw attention and investor dollars away from index funds. Wall Street firms may also benefit from the higher trading activity associated with actively managed funds, as investors tend to buy and sell them more frequently than index funds. It's not just that Wall Street is hiding the benefits of index funds from you. They're actively working to steer you towards more expensive actively managed funds. Through the slick marketing campaigns and high-profile fund managers, Wall Street is using every trick in the book to lure you into buying their products, even if it means charging you exorbitant fees and commissions. One of the most notorious firms for charging customers excessive fees is Wells Fargo. In 2016, it was revealed that Wells Fargo had opened millions of fake accounts on behalf of its customers without their knowledge or consent. The scandal led to a $3 billion fine and significant damages to the bank's reputation. As an example, Eric Allen, a business owner, lost his business after Wells Fargo charged him excessive fees and interest rates on a loan. Allen had taken out a $10,000 loan to help his business through a slow period, but ended up owing more than $20,000 due to the bank's predatory lending practices. Allen owned a small business called ARTICH Joe's, a family-owned card club located in San Bruno, California. In 2012, Allen took out a $10,000 loan from Wells Fargo to help his business through a slow period. However, the loan came with a high interest rate and hidden fees that quickly added up. Despite making regular payments on the loan, Allen ended up owing over $20,000 due to the bank's predatory lending practices. The high cost of the loan ultimately forced Allen to close his business, which had been a fixture in the community for over 100 years. But the fake accounts were just the tip of the iceberg. For years, Wells Fargo had also been charging customers for unnecessary products and services, including insurance policies and overdraft protection, which often resulted in overdraft fees and other penalties. The bank also engaged in predatory lending practices, targeting low-income and minority communities with subprime mortgages and other high-risk loans. In total, Wells Fargo's unethical practices resulted in billions of dollars in profits for the bank while leaving many of its customers in dire financial straits. It's a chilling reminder that even some of the most well-known financial institutions can be motivated by greed and a willingness to exploit their customers. Index funds should be more popular investment options for many investors due to their low expenses, diversification, and ease of use. Two popular index funds that investors can purchase are the SPDR S&P 500 ETF Trust, which is ticker symbol SPY, and the ticker is QQQ. SPY tracks the S&P 500 index, which includes 500 of the largest US companies, while QQQ tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ stock market. Both of these index funds have provided strong average year-over-year returns, with SPY averaging around 13% and QQQ averaging around 20% over the past 5 years. I can't say the same for Wall Street's hedge funds and other actively managed funds. Numerous studies have shown that on average, hedge funds tend to underperform after fees. For example, a study conducted by research firm Hedge Fund Research found that the average hedge fund returned 5.5% in 2020, while the S&P 500 index returned over 16% in the same period. Additionally, a report by the financial data provider Preqin found that hedge funds generate an average net return of 5.4% in 2019 compared to the S&P 500 index's return of 18.4% over the same period. These figures illustrate that hedge funds on average struggle to outperform the broader market even before accounting for their high fees. And that's why I'm urging you not to fall for Wall Street's manipulation. Check the financial institution behind your investments. But not surprisingly, there's more Wall Street is hiding from you. In addition to high fees and manipulating customers away from index funds, Wall Street uses technology to get retail investors right where they want them. In recent years, some Wall Street firms have been accused of using high-frequency trading algorithms to front-run their clients' orders. This means that they use their faster access to market data to execute trades before their clients' orders can be filled, potentially costing their clients millions of dollars. High-frequency trading, or HFT, is a type of trading that uses powerful computers and algorithms to execute trades at lightning-fast speeds. HFT firms use advanced technology to analyze market data and identify trading opportunities and then execute trades in a fraction of a second, much faster than a human can or even has access to. This gives these firms the ability to harm retail investors through a practice called front running. Front running occurs when an HFT firm uses its faster access to market data to execute trades ahead of its clients' orders. For example, if a retail investor places an order to buy 1,000 shares of a stock at $50 per share, a high-frequency trading firm could use its faster access to market data to quickly buy all of the available shares at $50 or less before the retail investor's order is executed. The high-frequency trading firm can then sell those shares to the retail investor at a higher price, pocketing the difference as a profit. The impact of front-running on fees can be significant, particularly for large institutional investors who may be buying or selling millions of shares at a time. Wall Street does not want you to know this and hides front-running by delaying trades, splitting orders, using dark pools, which, if you subscribe, will be the next video released. While splitting orders or using dark pools can be legitimate strategies, they can also be used to deceive other market participants if they are not used appropriately. One example of a firm that has been accused of front-running is Goldman Sachs. In 2015, the New York State Department of Financial Services, or the NYDFS, fined Goldman Sachs $50 million for violating New York state law by using its high-frequency trading platform to gain an unfair advantage over other traders. According to the NYDFS, Goldman Sachs uses high-frequency trading platform to execute trades ahead of its clients' orders, essentially front-running its clients and profiting at their expense. The NYDFS alleged that Goldman Sachs engaged in this behavior from 2007 to 2013 and that the firm made tens of millions of dollars in profits as a result. The case against Goldman Sachs is just one example of how Wall Street firms can harm their clients through front running. Something even more sinister and secret Wall Street doesn't want you to know is how they use your tax dollars. So you're a BlackRock CEO, Larry Fink, and you've spent the last few decades of your life building BlackRock into the world's largest asset manager, an investment company responsible for around $10 trillion. BlackRock has had its hand in literally every aspect of your life, and you got the $10 trillion not in the most legitimate way. BlackRock's investments are fueled by profit, not philanthropy. The company's history of success is built on making smart, strategic moves that maximize returns. And when it comes to Ukraine, BlackRock has calculated the potential for profit is simply too great to ignore, and your tax dollars are fueling it. With a reconstruction project on the horizon, BlackRock is poised to invest heavily in the war-torn country, Ukraine, with the expectation of significant returns. But there's a darker undercurrent to this investment opportunity Wall Street doesn't want you to know. The very fact that Ukraine is in need of reconstruction is a testament to the brutal conflict that has ravaged the country for years. And with tensions still simmering between Ukraine and its powerful neighbor to the east, you see, Wall Street, the symbol of America's financial industry, Wall Street has always been adept at finding ways to maximize profit, and BlackRock is no exception. In the case of Ukraine, BlackRock has found a way to tap into the government's coffers and, by extension, the taxpayers' money to fund its investment project. The promise of government contracts and subsidies has made Ukraine an attractive target for BlackRock's investment dollars, allowing the company to pursue its profit-driven goals with little regard for the broader social and political implications. But the use of taxpayer money to fund BlackRock's investment in Ukraine raises a host of troubling questions. Is it ethical for a private investment company to profit from a country's suffering, particularly when the profit is subsidized by public funds? What are the long-term consequences of funneling taxpayer money into a foreign investment project, particularly one that is tied to a nation in war and conflict? Wall Street, including BlackRock, often keeps its plans and objectives under wraps and is very secretive about their objectives from the public. First and foremost, the financial industry is highly competitive, and companies like BlackRock are constantly seeking to gain an edge over their rivals. By keeping their strategies and investments confidential, they are able to maintain an advantage in the market, making it harder for others to copy their moves or undercut their profits. The secrecy surrounding Wall Street and BlackRock's investments is a natural consequence of a very highly competitive and complex industry that operates on a global scale. However, Wall Street keeping these secrets is frustrating for the public and regulators who seek greater transparency. Speaking about transparency, CEOs on Wall Street have significant discretion over how they spend investor money, and there is often little transparency or oversight into their decision making. In some cases, CEOs may use investor money to fund lavish perks and personal expenses such as private jets, luxury homes, and extravagant vacations. One high-profile example of a CEO using investor money to fund lavish personal expenses is the case of former Tyco International CEO Denis Kovlovsky. Kovlovsky was convicted in 2005 of using corporate funds to finance extravagant personal spending, including a $30 million Fifth Avenue apartment, a $6,000 shower curtain, and a $2 million birthday party for his wife on the island of Sardinia. Kozlovsky's spending was revealed during an investigation in Tyco's finances, and he was eventually sentenced to prison for up to 25 years for fraud and other charges. It's difficult to estimate how many CEOs misuse funds, as such behavior is often hidden and can be difficult to detect. Probably because Wall Street doesn't want you to know. There is no reliable data or estimates available on the exact number of CEOs who misuse funds, but safe to say it happens often. While Wall Street may claim to act in the best interests of their clients and investors, the reality is that profit is often the primary motivation driving their decisions. That's why it's more important than ever to stay informed and engaged in the financial world and being a subscriber of Wall Street Wealth.